Today we will show you why the survival kit is vital for long-term investors in this volatile market phase. Plus we will explain why small caps should play a central role and why diversification means offense, not just defense. Last week's market's drawdown marked a turning point. The S&P 500, the Dow Jones Industrial Average, the Nasdaq and even the MSCI World have been stuck in the flat stagflation since the beginning of this year. This should not influence your defensive and long-term investment decisions, but can be frustrating and demotivating. Therefore, we will give you concrete ideas on how to actively manage your individual stock portfolio while staying invested in your long-term ETFs. Even Buffett's successor, Greg Abel, delivers great investment ideas. He calls Coca-Cola, one of our favorite value stocks, as so-called forever stock. In his inauguration letter, he writes, "A large portion of our portfolio is concentrated in a small number of American companies such as Apple, American Express, Coca-Cola and Moody's. Businesses we understand well, have a high regard for their leaders and expect will compound over decades." As we currently head into another oil shock crisis, one can ask the question, how crisis-proof is Coke really? The answer is simple. Coke weathered some of the biggest economic crises. The Great Crash of 1929, World War II, the oil crisis in 1979, the dot-com crisis, the financial crisis, and the Corona crash, to name just the most severe ones. And during all these crises, Coke served as an anchor as they always paid dividends. Plus, they increased the dividends since 1963 every consecutive year. Even today, Coke is trading around 9% below its 10-year PE ratio while paying a hefty 2.75% in dividends. A solid buy for us until better bargains appear. So it's no surprise Greg Abel defines Coke as forever stock. At the same time, Abel also buys more shares of Berkshire Hathaway, which currently holds cash and US treasuries of more than $370 billion. As a great alternative to our ETF exposure, we can also clearly see Berkshire stock, which is currently trading 11% above its 10-year PE ratio. But it's still a safe haven, with most of its capital invested in boring stocks such as Coke or the Burlington Northern and Santa Fe Railway Company, which is fully owned by Berkshire. All while piling up a good amount of cash. The cash for Berkshire is crucial to have the buying power if and only if the market turns into a crash or crisis, and bargains can be collected at super low valuations. In such a crisis, a good and perfectly prepared plan beforehand can be your financial survival kit. As oil surges above $90 per barrel and 20% of the worldwide LNG supply is missing because of the US-Iran war, we can see a darker than brighter sky for the current market phase. But here comes our survival kit into play through the following 3 rules. First, find bargains can be very hard and needs a lot of discipline. It most often does not happen overnight, so search for long-term defensive stocks like Coke and think of a fair PE ratio at which the margin of safety is high, depending on the quality of the stock and its last 10-year PE ratio. Second, try to keep at least 20% cash ready to pull the trigger if the broad market dips, when tensions rise, or the PE ratios of your identified stocks drop. Third, keep your base investments in ETFs and foster your diversification by investing more broadly than just the S&P 500 or even the MSCI World. Include small caps and international ones. To give you a small inspiration to identify currently undervalued or fair valued stocks, we found current bargains such as Canadian National Railway, which is still trading slightly below its 10-year median PE ratio and might benefit from the current oil crisis through more local production in Canada and a spike in its petrochemical segment. Beyond the classic value stocks, Microsoft might also be trading in bargain territory. With a median PE ratio of around 34 and a current PE ratio of just 25.6, which is a hefty price cut of 25%. Microsoft's current valuation is the same as it was in the middle of the 2020 Corona crash or during the 2022 interest hike by the Fed to fight inflation. If you want to profit from the current oil spike, it might be worth looking for stocks currently under pressure, such as the cruise liners. We see a fair value for Royal Caribbean Cruises that almost matches the 10-year PE ratio while paying a solid dividend of 2.16%. The most important thing is to stay motivated, either by researching and investing in bargains you like or by optimizing your long-term ETF portfolio. It is important for the ETF portfolio to have a solid mix of worldwide large companies, small caps, and international stocks. Especially small caps and international stocks should not be neglected, as they seem to be starting their revival this year. As Jason Zweig wrote in his newsletter lately, most investors seem to think diversification as defense. Suddenly it's playing offense. Thanks for watching and keep investing.